The second type of adjusting entry is deferred revenue. Like deferred expenses, this is when the cash comes first before the service or we have actually earned it. So an example of this would be the original entry would be something like we got paid $1,000 to perform consulting services over the next 2 months. So we got $1,000 for 2 months. And let's say this happened on July 1st. The journal entry on July 1st then would be we got cash, so we would debit cash of $1,000 and credit unearned revenue of $1,000. Now, just as a reminder, unearned revenue is a liability. A liability is something that we owe, and it's not always cash. In this case, the thing that we owe is the service. So in the future, we are going to have to perform these services for our clients. All right, so over the next 2 months, we are going to perform these services. So let's say it comes to July 31st. What has now happened? Well, 1 month has passed and we have done some work. So we have actually earned some of this $1,000. And presumably, since this $1,000 was for 2 months, we have now earned half of it, or $500. So the adjusting entry would be we have this unearned revenue, this liability is being reduced because we don't owe as much anymore. So we are going to debit unearned revenue, 500, and we have earned this money, so we are going to credit service revenue or some type of earned revenue account. And this is going to be the pattern for all of the deferred revenues. We are going to debit some sort of liability and credit some sort of revenue. Essentially, what we are doing is we are saying this is something that we owed and we have done some sort of service or work in order to earn it. So we have changed it from unearned to earned revenue.